Welcome back. You tune into Markets at Noon with me, Ankita Saxena, and with me is Ashesha Adviryu, and we are getting you all the roundup of the market and the earnings. And now we have an earnings candidate that we're focusing on, and that's Pace Digitech. We have the management that's joining in. The numbers look a little weak for the second quarter of FY27 for Pace Digitech. We did see a sharp decline in their revenue and profits as well, but their key focus remains on the telecom business and the revenues. And to weigh in more on the growth roadmap ahead, we are now joined by Venugopalr, Maddisetty, the chairman and managing director of Pace Digitech. Hello, Mr. Maddisetty. Thank you so much for taking the time out and joining us. It has been a weak quarter, even though the expenses in the second quarter have been much lower. What explains the significant drop in the revenues and profitability both year on year and on a sequential basis?
Yeah, this is basically the projects that we are executing. Normally there are two phases, the execution phase as well as the supply phase. Starts with the material supply, which majorly happened last year, and the execution that is more of services that's happening in this financial year. So that is the only reason why there's a small, there's a decline in the top line, but the PAT remains, at about 12% strong, and there's no any other concern other than this. And we are already, and on the energy side, whatever the orders we have booked, energy being the new business for us, it is just picking up. Order book is quite strong, and the execution will start from a few months from now onwards. And we believe that the energy business would be strongly building the balance sheet for the FY27 onwards.
Okay, so you're saying that the order book position is very strong and that energy business will drive revenue growth for the company. But now, since this year so far, for the first 2 quarters, revenue growth has been tepid. Do you expect the second half of the year to be better than the first half? And do you expect to perhaps surpass that FY25 revenue for the full year FY26 as well?
Yes, we are going to cross the FY25 numbers, and with the equal, the percentage of profits as well. There is no concern, except for that, as I said, that the majority of the supplies happened, so the top line was looking slightly better last year than this year. But the orders are under execution, and we are going to achieve more than the last year's, the revenues.
Also, has the telecom continues to maintain the largest share in your revenue mix? Is that trend expected to continue, or could there be any increase once the acquisition of your subsidiary, Pace Renewable Energies, is completed?
Yes, now the telecom is the major contributor for our revenues. But going forward, this order book, we have a strong order book on the energy sector, and the energy business is going to start, getting reflected on the balance sheet. To a certain extent this year meaning the Q3 and Q4, majorly Q4. And then the Q1 onwards, there'll be a minimum of 50% of revenue of energy would be reflected on our balance sheet. Because the orders which we have, we are executing now them, and then the billing will start, majorly from the Q1 of next financial year.
Okay, that's as far as the energy segment is concerned, but I wanted to ask a follow-up question. You did tell us that for FY26, FY25 revenue is likely to be surpassed. This year, yes, so far you have registered sales of about 800 crores versus last year of about 2,400 crores. So are you suggesting...
It's 900 crores we have crossed this year, and 2,438 was last year, and we are going to cross that because see, in the infrastructure business, the H1 and H2 is always, we call it as 1/3 and 2/3 between H1 and H2. And more or less, we are going to be in that. And we are going to cross this 2,438 crores for sure with the PAT of about 12%.
And what about margins then? They've been, they've come in at about 18% in the September quarter. Is that sustainable going forward? What's the outlook when it comes to margins?
Yeah, the margins are good for us because it's more of services we are doing. The services are having better margins, and we are going to have maintained the same percentage of the PAT in this balance sheet also.
All right, on that note, Mr. Rao, thank you so much for taking the time out and joining us and weighing in on the numbers. With that, it's time for us to step into a short break. Don't go anywhere. After the break, we're getting you more managements and discussions. Stay tuned.